Welcome to this explainer, where today we're breaking down the absolute critical differences between India's old and new tax regimes for non-residents heading into the 2026-2027 assessment year. Look, if you're navigating your cross-border finances, you are exactly in the right place.
Because, let's be real, this simple question is basically the ultimate headache for NRIs and returning expats. Doing taxes is painful enough as it is, right? But paying more than you legally have to? That is literally the worst. Unnecessary tax can eat into your returns way faster than market volatility ever could. And choosing the wrong tax regime? Well, that can mean leaving lakhs of rupees just sitting on the table. So we're going to figure out how to optimize your portfolio and make sure you aren't paying a single rupee more than required. So here's our roadmap for today. First, we'll look at the new default regime. Then we'll compare the tax slabs. Third, we'll dive into the deduction dilemma. Fourth, we're looking at surcharges for high earners. And finally, number 5, which one should you actually choose? Let's get right into it. Number 1, the new default regime. The shift in 2026-2027. Okay, we need to establish the ground rules of this recent shift in the tax code because the landscape has officially changed.
On one hand, the new regime under Section 115 BAC is now the automatic default. It's designed to be completely simplified, so it requires virtually zero tracking of receipts. Super easy. But on the other hand, the old regime hasn't totally disappeared. It's still there as an opt-in path for those of you who really love customizing your deductions. And actually, while digging into the fine print, we uncovered a pretty helpful pro tip. If you happen to have business income, you can still opt out using Form 10 IEA, but just keep in mind that switching in and out is highly restricted. Now, for most non-business NRIs, you'll just make this choice directly on your return every single year.
Moving on to number 2, comparing the tax slabs to baseline rates. Let's see how these base rates build up from 0 all the way to 30%, because this is exactly where the new regime really tries to win you over.
Now, what is really fascinating here is how the new regime essentially spreads out the pain of paying taxes. Under the new rules, the maximum 30% rate is totally delayed until you hit 24 lakhs of income. It just steps up gently, 10% at 8 lakhs, 15% at 12 lakhs, and so on. But the old regime, it slams you with that top 30% bracket the second your income crosses just 10 lakh rupees. It's a huge difference.
And that brings us to a really crucial point, the Section 87A rebate. We actually verify that the tax department specifically notes non-resident individuals are eligible for this. Under the new regime, if your taxable income stays under 12 lakhs, you get a rebate of up to 60,000 rupees. Do you know what that means? It means your final tax bill is essentially zero, nothing. Compare that to the old regime, where the threshold is just 5 lakhs with a tiny 12,500 rupee rebate. For moderate incomes, the new regime is looking incredibly attractive right now.
All right, part 3, the deduction dilemma. What you keep versus what you lose. Because honestly, to get those extended lower slab rates in the new regime, you're going to have to make a major trade-off with your tax deductions. There is simply no free lunch in tax policy. If you do switch to the simplified new regime, you completely forfeit some beloved deductions. Section 80C, 80D, and 24B are just totally wiped out under the new default rules. So we really need to weigh exactly what you're giving up here to see if those wider tax slabs are actually worth it for you.
And this number right here brilliantly illustrates the impact. 1,50,000 rupees. That is the hard limit on the combined Section 80C deductions you completely lose out on if you abandon the old regime. We're talking common investments like your life insurance premiums, provident fund contributions, even tuition fees. If you habitually max this out every single year, waving goodbye to it under the new regime is a pretty significant mathematical sacrifice.
Additionally, if you're paying health insurance premiums for yourself and senior citizen parents, you're potentially leaving a massive deduction on the table. Under Section 80D in the old regime, NRIs below 60 can claim up to 25,000 rupees for their own family, plus another 50,000 rupees for senior citizen parents. And hey, if you yourself are a senior paying for senior parents, that deduction can reach a potential 1 lakh rupees. The new regime, it offers absolutely none of this.
Furthermore, if you're paying down a self-occupied property loan, the old regime shelters up to 2 lakhs of that interest from being taxed.
And here's a really fascinating detail from the rules. Even if your property was purchased way back after April 1999, that 2 lakh rupee deduction under Section 24B still applies. If you've got a heavy mortgage in India, the old regime's ability to absorb that interest might just completely outweigh the new regime's lower base rates.
Number 4. Surcharges for high earners, the hidden high roller fees. For the high net worth NRIs tuning in, let's slow down for a second and look at the fine print regarding surcharges, because this is where standard calculations completely flip on their head.
Once your income crosses that 50 lakh rupee mark, the government tacks on an extra surcharge percentage right on top of your base tax. It scales up fast, 10% for income up to 1 crore, 15% up to 2 crores, and 25% for income up to 5 crores. Notice that up to this 5 crore mark, these surcharges apply exactly the same way under both the old and the new regimes. Oh, and just a friendly heads up to help you plan accurately, don't forget that a 4% health and education cess is added on top of all of this.
But right here is where the scales tip dramatically. For massive incomes exceeding 5 crores, the old regime punishes you with a whopping 37% surcharge. The new regime, however, permanently caps that surcharge at 25%. Guys, that is a massive 12% gap in the surcharge rate alone for top-tier earners.
This specific rule, straight from the Income Tax Department's guidelines, is a total game changer. It means that if you have a massive liquidity event, let's say you sell a major Indian property, or you just have an ultra-high income year that crosses that 5 crore threshold, the new regime is almost certainly the mathematical winner. The savings you get from the surcharge cap will effortlessly dwarf any missing 80C or 80D deductions.
And finally, number 5, which should you choose? Your optimization framework. Let's pull all of this together so you can actually choose the right path for your specific financial footprint. There is absolutely no one-size-fits-all answer here. It just requires a little bit of math.
You must run this 3-step comparative analysis on your own portfolio, and you absolutely have the tools to do it. First, isolate your Indian-sourced income. Second, add up exactly what you would claim under 80C, 80D, and housing interest. Third, just run the math. Because if your deductions are lower than the tax savings provided by the new extended slabs, or if you have an income over 5 crores, the new default regime is your best friend. But if you have heavy deductions, especially a really big mortgage, opting into the old regime might still save you thousands.
The tools are right in front of you, and the rules are crystal clear. The transition to the new default regime definitely makes things simpler, but as we've seen, simpler doesn't always mean cheaper. So, the ultimate question is, have you run your own numbers yet? Because you definitely don't want to leave money on the table. Thanks for joining me on this explainer, and I'll catch you in the next one.